I'm Steve Daly. As Dr. Bryce mentioned, I'm the CEO of Ivanti, and Ivanti is we're based here out of Utah. So we're in South Jordan, and we've as David said, we rebranded the company about 2 years ago, as we did we merged two companies together, but. The company that, kind of the original DNA of the company comes from a business called Landesk. And Landesk was part of Intel back in the early 90s and based here out of Utah. So first down in the river bottoms and then over in American Fork where the Domo buildings are right now. And that's where I first became associated with Landesk. So I was working for Intel. I worked for Intel about 10 years, and about 5 of those years I was associated with Landesk. And if you look at this, we've kind of grown the business over time. So I left. I was part of Landesk. I left Landesk in 2002. I left Intel in 2002. And I say left. I got fired. From Intel, and if this were a kind of career and personal development, I could talk for days about what I learned through that process. But I went to do a startup in Draper after that, and we were really small. There was 4 of us to start with, and about a year later, we ended up selling the startup to a company called Avicent, which was based out of Huntsville, Alabama, and I went to work for them. I ended up, after a few years, moved back to Alabama to run corporate strategy for Avicent, and part of our strategy was we wanted to expand our portfolio. We were very much data center focused, and we wanted to get a desktop to data center strategy. And we ended up acquiring Landesk, which had subsequently spun out of Intel, and they asked me to come back to run Landesk at that time. And so this was kind of 2007 timeframe, and the challenge that we had at that time was that when I came back, it was about $95 million in revenue, and 85% of that revenue came from one product, a suite for managing desktops, and subsequently, a couple years later, Avicent was actually acquired by Emerson Electric, and they were really focused on the data center, so they spun us out, and so we did a leveraged buyout with private equity and became a standalone company in 2010. So by this time we had acquired TouchPaper, and so now we got a couple products. It was a pretty small product line, and so about still 75% of our business was based on this desktop management suite. And in 2011-ish timeframe, just after we had spun out, Microsoft came out and said, look, we've got this product, and we'd always competed with Microsoft on some level, but their products weren't very good. But they were coming out with a product that actually was pretty good, and they were giving it to their customers that had enterprise agreements. So it was free, essentially. And this is a product associated with 75% of our revenue. And so we began, and fortunately at this time we were part of private equity. The investment thesis had been, this is a platform company, we're going to acquire and bolt on to this platform company. And so we went into acquisition mode. And I would say, as I think about these growth vectors, and I'll talk to you a little bit, I'll show you kind of bubble charts on David's framework about how they fit. But as I was thinking about acquisition strategies, they're hard, but the reality is, if you need to pivot, like we needed to pivot, it was the only option, because the organic growth strategies was really, it takes a while, and as Dr. Bryce talked about, right, they take a while to matriculate into meaningful businesses. It's the whole innovator's dilemma challenge when you're going after new markets. And so we had to go through an acquisition strategy in order to pivot the company. Today, we're about $500 million. That business is about 8% of our new business bookings. And so we've successfully pivoted away from that, that part of the business, but we could not have done that without an acquisition strategy. And so as I've thought about the acquisition strategy, there's a couple things I wanted to share about if this is something that that is interesting for a company. Is one, it's not easy. So I think it's just as fraught with risk as an organic strategy is. You're going to make some bets and you're going to hope it's going to pay off, but it is just as fraught with risk because it's not an easy thing to do to bring a couple companies together. And as I was, my 10 years at Intel, we were horrible at acquisitions. I mean, you've seen it. You've seen the big ones. We did a bunch of littler ones that didn't kind of hit the radar. But McAfee. Now we're spinning McAfee out. There's just been a lot of. Intel was just not very good at it, and I don't think a lot of big companies are very good at it. And we never could figure out, the formula for being able to do acquisitions well at Intel. In fact, I spent the 6 months before my youngest daughter was born, I was commuting back from here to Boston trying to save one of our big acquisitions. And ultimately, all it did was give me a lot of miles because it ended up going under anyways. And so it is a difficult thing to do, but there are ways that you can de-risk it. And the first thing is, you have to be very disciplined when it comes to acquisitions. And they have a saying, if you're any boat owners in here? Anybody own boats? Nobody wants to raise their hand? Nobody owns boats. Yeah. Maybe you don't own a boat. But they always say the best 2 days of boat ownership are the day you buy it and the day you sell it. Right? And it's the same with acquisitions. If you do not do a good job buying, it's really hard to create enterprise value when you sell. And I learned this in spades. Again, great training as part of a private equity model is that it's that purchase price that really determines how well you're going to do. And in big corporations, it's really hard to do that. I remember when we were spinning out of Emerson, the VP of corporate strategy at Emerson, we were all in a room and he was just talking and they were trying to do a deal. Actually, they're trying to spin out another part of their business, and they said, what exec do you know that once they get enamored with a business, that they won't just pay whatever it takes to get the deal done? And I think, from what I heard later, he fell prey to that trap, and he actually got fired from Emerson. He sold it. He bought a business, and the price right at the end went way up, and he went ahead and paid it, and it ended up not being successful. So it's really hard to keep that discipline, especially once you get deal fever and you start to get excited about the technology and what you can do with it and those types of things. We have an example when I show you our acquisitions here. In fact, I won't say who it is because it's kind of embarrassing for him. But we carved out a business out of a Fortune 50 tech company. And the funny thing is, 2 years earlier, we had tried to buy that business when it was a standalone company, and we lost to this Fortune 50 company. We were going to pay. This company was doing. I think it was $20 million of revenue or something. It was kind of nichey, and the Fortune 50 company ended up paying $100 million for it. It's out of our price range, right? And so we lost that deal. 2 years later, they have a strategy shift. The company hadn't been doing very well. It was now doing $30 million within the company, which is pretty good growth, but it didn't align, and so they were getting ready to carve it out. And so we went back and talked to them. We ended up buying that business for $30 million. So again, it was this lack of discipline. There's a lot of things that went into that, but again, staying focused and staying disciplined in that process up front is really, really important. That acquisition itself, we sold Landesk in 2017. We sold it to another private equity firm who merged us with Heat down here and created Ivanti. That's why we rebranded the company at the time. But that, and I'll show you some of the value creation. That acquisition alone created about $200 million, almost $200 million of enterprise value, just because we were able to buy it well. So discipline is super important in that process. I would say that the next thing is something that also I've seen in big companies, even with the private equity firms that we worked with, is a lot of times you'll get these corporate strategy groups that are in charge of M&A, and then they go off and figure out what to buy. They do the deal. They talk to the product groups and that kind of stuff, and then they come in and they do the acquisition. You have an acquisition team that does the acquisition, and then you throw it over the wall to the company to go integrate and figure out how to do. from day one, the way we approached it was any acquisition we were considering, we included the executive leadership team or the next level down in our early discussions with the companies. And that what that did was it allowed us to get alignment across the organization, so that when we finally did do the deal, everybody was on board. Everybody kind of knew the investment thesis, and it wasn't kind of an throw it over the wall type of thing. Now, the private equity guys, we've been looking at a number of these, and I got a call from the partner going, you know what, you guys bring a lot of people to these meetings. Are you sure you want to do that? Because usually when we do this, it's usually the CEO and the corp strategy or corp dev person that's in all those meetings. But I believe it costs a little more. It's a little bit more overhead, but it allowed us, of all the acquisitions that we've done, there's only one that I regret doing. And that brings me to kind of my fourth point here, which is you got to trust your gut in this process. Now, I'm a firm believer in the kind of the Reagan era trust but verify idea. So verify everything with data, but in the end, you've got to trust what your gut is telling you about a deal. So we had a deal that we did. We were getting ready to carve out another business, and it was big. It was probably the same size as us. It was about, at the time, maybe a little bigger. It was about $250 million business, carving it out of a Fortune 50 that had kind of bought something, lower. They bought it for $1 billion, right? We were going to buy it for much less than that, and it made sense, right? It was, but in the back of my mind, there was just something that it was just bugging me, and I couldn't get over it. We kept going through the process, doing the board meetings, and finally the chairman of the board said, "I don't feel good about this," and it gave me kind of finally I said, I jumped on that one. Me neither. Let's not do this. Now we found out the business since has gone into kind of a steep, it's like a falling knife decline, and so I think we dodged a bullet there. On the other hand, I made a mistake, and we were doing we'd gone through a process where we were trying to mark the value of our company, so we went and talked to a bunch of private equity firms, and what would they pay for us, and we'd gone through this product, and during that process, they had hit on a couple things in our business that they didn't like, and one of them was our mobile strategy, and so I was really sensitive to the fact that I didn't have a great mobile strategy, and so I felt compelled to go out and get some of that technology and bring that into the company. And so we found this small company based out of Israel that was doing some really cool stuff in mobile, and the technology was really exciting. But this is one of those times when my gut was saying, I don't think we should do this. But the reality was we had momentum. I was really worried about having this part of my strategy filled out and having the checkbox to be able to talk about this. My salesperson was absolutely against it. He didn't want to do it, right? He was like, and he gave some great examples. He said, look, this deal size is too small. Our guys aren't going to be interested in it. It doesn't align with their sales motion. Our channels aren't going to pick it up. And yet there was a ton of momentum within the company, and it felt wrong to me to do it. And the board pushed back, and I laid in the tracks to get the deal done, and I destroyed enterprise value in the process because I went ahead and did it, and I went against my gut in that process. And so again, trust but verify, but don't underestimate the value of what your gut is telling you, because it will tell you, it will give you good guidance, despite as long as you've got some data to back it up. And then I'd say the final thing is always to remember that you're dealing with people when it comes to acquisitions. And that makes it hard. A lot of times we get into the models and we say, okay, it aligns here, it aligns here. The reality is you're buying, when you buy a company, technology is important, but and I'm in software, software is copyable, right? People can once they figure out what you're doing, it's easy for them, two people in a garage in Beijing to copy what you did. It's the people that are involved, and that can be both good and bad. So you got to marry your cultures. And this is one of the things that Intel was horrible at. Intel had a very, very, very strong culture, and so when a startup came in or a company that had a different culture, it was either align or die. And a lot of times, it was die. So it's more, I heard it described once as it's more like a marriage than it is, an acquisition. And you got to figure out how to marry those cultures. Now, the other thing we do every time we do this is we usually take out the most senior level of management, because that's where you will get resistance to these acquisitions. That is where they've got their strategy. They've built the culture, and so if you want to change that culture at all, it's really hard for the senior level of management. So usually we take that layer out in the process of doing an acquisition, and then nurture everybody else. And we try to do that, again, if we are focusing on cost and capability synergies on Dr. Bryce's model, we'll do that right up front. And we'll get it done and say, okay, we're done. You don't have to worry about what's happening. This is the go-forward team. Now, this strategy, this is a chart that Thoma Bravo, our private equity firm, when they sold us, did. They bought us for about $200 million. They levered up on it. It was $120 million of equity value, and they sold us for $1.2 billion 6 years later, and created about almost $1 billion of equity value. And you can see from this chart, the gains from acquisition were almost $400 million. And frankly, the multiple expansion you could attribute to that acquisition, because again, as a single product, a very competitive market into a multi-product, much more scaled business, that's where we got our multiple expansion. And so you can see there was some, we still had to do work, but 2/3 of that value was created by this acquisition strategy as we went through this. So I'll just go really quickly through a couple of the slides here. We did our first acquisition in 2012. We had 2 of them. Wavelength was this was again a response to mobile, the mobile question that had come up a lot in our conversations, and we bought a company that was frankly not really aligned to either our customers or our capabilities. And we used some of the technology in other parts of our business, but what we learned was we had to run that separately. So we still today have a separate sales team that sells these products. We run it, even though it's not a huge business, we still run it separately, almost like its own business unit, because there weren't good alignment on either of those axes. But we did take some technology out of it, which was why it was important. Then we did a couple acquisitions in 2012 and 14, a couple smaller ones. That LEP Mobile is the one that I regret doing. That's the one where I destroyed value. But an interesting thing, back to Dr. Bryce's point, is as you make acquisitions or as you make these investments, the network effect is that Nartec, it was a fairly small business, but it was very complementary to Wavelength. So if we had done Nartec first, that thing would have died on the vine. But because we already had that capability with the Wavelength acquisition, that thing's been wildly successful for us, and it's given us dominant market share in that place and in that market, and allowed us to be much more successful because of that. And then we did a few more acquisitions. We started to do larger acquisitions. I think the point is that the other thing that's interesting here is that there's 2 things that kind of drive your success in these, but as you can see, as we did more of these acquisitions, more of the future acquisitions fell to the upper right quadrant, right? Again, all of these acquisitions would have been, somewhere down on one of these axes, would have been really low on one of these axes if we had tried to do those acquisitions when we were that one product desktop management company. And so there is a network effect, there's a multiplier effect as you are successful making those acquisitions, that then it becomes, you have a bigger base on which to find synergies going forward. And then I'd say it's also a skill set thing. So it's just like anything else, a company that's good at introducing new products, a company that's good at acquiring, as you kind of hone that skill set, then your probability of success goes up greatly. So I love the model. I think it's a great way to think about the business. I think we've gone in retrospect and dropped these on there, but it's something that we'll use as we look for acquisitions going forward. So thank you very much.